All right, now let me tell you about an HR professional I work with named Danielle. She was 45, corporate HR, been in the field a long time, salary, stable paycheck, good benefits. On paper, everything looked good, responsible, and put together. What pushed her to reach out didn't happen at work. It happened quietly at home. Her son needed braces. Not cosmetic, not optional. Insurance covered part of it, but not all. The out of pocket number was bigger than she expected, and it was due fast. Her first thought was a credit card, and she did not love that. She deals with employee financial stress all day. She knows how that ends. She looked at her retirement account. She had a 401k. She knew she could borrow from it. She didn't like the idea, but felt like it was the cleanest option. So she did. At first, everything felt fine. The money showed up, the braces got handled, life moved on. Then her next paycheck hit. She noticed the loan repayment coming out automatically after taxes. That's when it started bothering her. Not because she was paying herself back, but because she didn't choose that. Every paycheck, the money was gone before she even got a chance to touch it. And that's when it clicked to her. She realized she was paying that loan back with after tax money, and then she'd pay taxes on it again later when she used it in retirement. That didn't sit right. So around the same time, she was talking with the coworker in HR, just normal conversation, kids, expenses, benefits, and how even people with good jobs still feel tight. Danielle mentioned the retirement loan and how it made her feel boxed in. That's when her coworker said she stopped borrowing from her 401k. She said she uses her life insurance policy instead. Danielle stopped and looked at her and said, "What do you mean?" Because to her, life insurance was something you enroll in through work and you forget about it. It's not something that you actually use. So she asked questions, and what she learned was simple. Her coworker had a permanent policy where she saved money. That money grew tax free. And when something came up, she could access it tax free without penalties, restrictions, or automatic repayments. No paycheck deductions, no borrowing from retirement, no double tax hit. That's when it really clicked. Danielle already had retirement savings. What she didn't have was flexibility. And she realized something else. The life insurance she had through work was tied to her job. So if she left, got laid off, or retired early, it didn't really solve much. So she reached out to me, and she told me exactly what she wanted, and that is what we built. Now, let me walk you through it. Okay. All right. So this is the plan we set up for Danielle. We designed it as a 5-year funding plan. She chose to put in $1,000 a month, which comes out to $12,000 a year. That number worked because it was money she was already saving. No lifestyle change, no budget stress, no relying on bonuses to make it work. To her, that meant having money she could access when something came up at home, not using credit cards and carrying balances, not borrowing from her 401k again and losing control of her paycheck. So from age 45 to 50, she's funding it at $12,000 a year. Over 5 years, that's $60,000 in total. Now, when you look at an illustration like this, there are only a few things that matter. First is the cash value. That is the money inside the policy earning interest. Early on, there are costs, and then the rest flows into the cash value bucket where it grows cash tax free. Next is the cash surrender value. This is the important one. This is how much money Danielle can actually access. Think of it like her available balance. She can use it if a family expense comes up, something unexpected hits, she needs money without touching retirement. When she uses it, no penalties, no age restrictions, no taxes, and no forced repayment. And nothing comes out automatically. She stays in full control. You'll also see a projected rate, okay? It's not a guarantee, it's just based on how the policy is designed and historical performance. Nothing aggressive, just steady growth without market risk. Now, after 5 years, here's the simple picture. She put in $60,000, and now she has a pool of money that is growing tax free, is accessible when life happens, doesn't create another problem when she uses it. Instead of choosing between credit cards or retirement loans, she now has another option, one that fits how life really works for her. Now, after age 50, she stopped funding it, so nothing else is going in. Now, She just lets it sit and do what it is designed to do. Okay. Now at 65, there's a meaningful amount of money sitting right there waiting for her, not just a number, but options. She also liked that if she wanted to retire earlier, step away from corporate life, or supplement the retirement without stress, she has something to lean on. At 70, same story, it's still growing, and she still has access to it. And if something happened to her, this plan doesn't disappear. There's a tax-free death benefit attached to it as well. That means her family isn't scrambling, expenses can be handled, and what she built doesn't just stop. For her, that is what mattered because this whole thing wasn't about benefits, it was about controlling her money. Now, if this sounds familiar, especially if you borrow from a 401k or don't like losing control of your paycheck when life happens, I'm happy to walk through this with you. We can look at what this could look like for you based on your income, your benefits, and how your money actually flows. So you can schedule a call below or just send me a message and we'll go from there. And I'll talk to you guys soon.